A Mochi moment from Sadie, who writes, I'm not crying, you're crying. This is what I said during my first appointment with my physician at Mochi, because I didn't have to convince him I needed a GLP-1. He understood, and I felt supported, not judged. I came for the weight loss and stayed for the empathy. Thanks, Sadie. I'm Myra Ahmed, founder of Mochi Health. To find your Mochi moment, visit joinmochi.com.
Sadie is a Mochi member compensated for her story.
DSW, Designer Shoe Warehouse, is the one-stop shop for all your footwear needs. With sneakers, boots, and everything in between for every style, mood, and occasion, you'll definitely find shoes that get you at prices that get your budget. DSW has what you need, but more importantly, they have what you didn't even know you wanted. You never know what you'll find at DSW. Find the shoes that get you at prices that get your budget at DSW stores or DSW.com.
Welcome to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. This week on the podcast, we are going to discuss the rising fears of an AI bubble and the fears that that bubble can lead to a stock market crash. I'm going to break down what a bubble is in the market and, of course, how to navigate these fears. For the past 2 weeks, I have been breaking down the current fears that are arising in the stock market over on patreon.com/investies. If you want a daily dose of economic content, join us over on Patreon. Join the opening bell tier. That is where I give daily doses of stock market news and also talk about the sentiment of investors. This is a great place to join community and, of course, ease the fears as you're learning to invest in the market. Over on patreon.com/investies, the opening bell tier. You can join for free for the first 7 days. Check it out. See if this is a community that you want to be a part of. Let's go ahead and check out how the market performed last week during these days of somewhat extreme fear. Now, before I get into that really quickly, I do want to highlight where this conversation and this narrative started. There were, of course, several catalysts that led us to the place where we are now. One of the catalysts for the fears that are circulating in the market was a tweet from Michael Burry. For those that don't know, Michael Burry is an investor that predicted the 2008 financial crisis. He is a very well-respected investor. There was a movie about his prediction. It is called The Big Short. I highly recommend that you watch this movie. He tweeted on October 31st, "Sometimes we see bubbles. Sometimes there is something to do about it. Sometimes the only winning move is not to play." Since that tweet on October 31st, Michael Burry has been releasing tweets where he is suggesting that tech companies might be massaging their numbers. He's hinting that by changing how they handle depreciation on their AI gear, they could be making their earnings look a little rosier than they really are. Michael Burry did take on 2 short positions publicly with NVIDIA and Palantir. A short position is basically betting that a stock is going to go down. So you're betting on that specific stock. It's like saying, I think this stock is too high right now, and I'm going to profit if it drops. So they make a bet that it will, in fact, go down. A lot of people are experts on shorting positions, Michael Burry being one of them, hence the title of the movie about him called The Big Short. We've talked about market manipulation in the past, But I think it's really important for me to reiterate market manipulation. Most importantly, when you have influence in the market. We've seen it with Trump over and over. There are people that have power in the market due to their platforms, and they have the ability to manipulate the market. I am not saying that Michael Burry is manipulating the market. What I am saying is that when an investor shorts a position, it behooves them to cause fears within the market because by default, the stock that they are shorting will tend to come down and they begin the process of making money on the way down in the market with the position that they hold. Now, I do think that Michael Burry is respected. I respect him. I do think that he has been wrong several times in the market. Obviously, he had a really big win in 2008 that put his name on the map and made us pay attention to the things he was saying. I don't necessarily think that he is wrong, but I do think that the amplification of his position helps him win. And we know for a fact that analysts will do this. They will create or generate some sort of hype around a stock or fears around the stock. And behind the scenes, they are making money on the way up and on the way down. This does not mean that I am completely dismissing what Michael Burry is saying just because he's making money on the back end. Absolutely not. I am still definitely paying attention to his perspective, of course, and what he feels he is seeing in the market. What I am saying is that I'm not necessarily going to take action based on what Michael Burry says. In the same way that I don't think that Warren Buffett is panicking over Michael Burry's tweets. I think that from my perspective in terms of being a long-term investor, yes, there are things that are going to come up and come down, and he is a short-term position type of guy. Like that is his thing. He will predict what happens in the short term. And as long-term investors, we need to keep our eyes on a time horizon that is 5, 10, 15, 20 years from now. And we have to know how to emotionally ride out the market on what is taking place in the short term. Now, where I think his advice is extremely valuable is in the space of speculation. I talk about this in my book and I talk about this in my course, Wealth Warrior. As beginner investors, we do not need to invest in speculative stocks because we will, in fact, get crushed. Most especially during times like these, where we just hit new all-time highs and there's all of this excitement and money that is flowing into the market, followed by extreme fear, followed by warnings on overvaluations. This is when we need to be very disciplined and not start placing bets on companies that are not yet producing results.
Rain-X wipers are the #1 wiper blades in America. That means all kinds of drivers choose Rain-X. Big drivers in small cars choose Rain-X. Small drivers in big cars choose Rain-X. Drivers with long hair and short commutes choose Rain-X. Drivers with short hair and long commutes choose Rain-X. Drivers with pets on board, babies on board, and bored babies on board choose Rain-X. Basically, drivers who love a clear view of the road all choose Rain-X wipers, the #1 wiper blades in America.
Building a portfolio with Fidelity Basket Portfolios is kind of like making a sandwich. It's as simple as picking your stocks and ETFs, sort of like your meats and other toppings, and managing it as one big, juicy investment. Now that's pretty good. Learn more at fidelity.com/baskets. Investing involves risk, including risk of loss. Fidelity Brokerage Services, LLC. Member NYSE SIPC.
Let's go ahead and move into what a stock market bubble is, because this is also part of what Michael Burry is warning against. And when we move into this topic specifically, we do have other analysts that are sharing the same fears and the same concerns. If you've read my book or if you have taken Wealth Warrior, the course, then you already know what a stock market bubble is. As a refresher, a stock market bubble is exactly what it sounds like. It is a bubble that gets really big and eventually it will pop. In other words, a stock market bubble is a rapid, unsustainable rise in stock market prices followed by a sharp collapse. Typically, this collapse occurs when there is speculation in the market and people have overvalued the company, meaning the price of the share is not worth what the actual company is producing, whether it is in results or whether it is in revenue. One of the most traumatizing examples of a stock market bubble, I would say, is the dot-com bubble, which took place in the late 1990s. I believe its official crash was in 1999. This was when technology stocks surged to incredible new all-time highs, and then the market crashed in the year 2000. But I want to put this into perspective to share with you what people were investing in, which is why I warn so much about speculative stocks. A lot of these companies did not recover. And part of the reason they didn't recover is because people were pouring their life savings into a technology company called pets.com. And that's all it was a website. I mean, you have to take into consideration that we're at the very beginning stages of the internet, and there wasn't necessarily anything sustainable behind pets.com other than there was an idea that people would be able to purchase things for their pets via this website. The company wasn't created. The only thing that existed was the website domain. There was clearly a lack of understanding of technology. People were taking stock tips and purchasing into all kinds of tech names. And so, yeah, we had a crash. And the majority of those companies did not recover. When there is speculation in the market about a potential crash, I typically do not feel fear. And I think I don't feel fear because I entered the market at a time where crashes happened every 10 to 12 years. And from my understanding and reflecting on the market, crashes were massive opportunities. 2008 was a massive opportunity. 2020 was a massive opportunity. And those opportunities were far and few between. And so for me, the way I was looking at money, I was understanding that during recessions and during crashes, any type of economic crisis was the potential for new millionaires to be born. However, I do want to acknowledge that I feel we are seeing different types of patterns in the market. We talked about this several episodes ago, where I think we're going to start seeing crashes take place more frequently. We have, in fact, seen 3 within the last 5 years. That has to be telling us something, and I think it cannot be ignored. Am I excited for a potential stock market crash? Yes, I can't help but to not be excited because, again, even though it's happening more frequently, it still doesn't take away from the potential opportunities that this can present. I also want to be completely honest with you that last week, I did in fact flinch. I did feel some fear. And I think this might have been my own trauma response. While I wasn't part of the 1999 tech bubble crash, I was a part of the 2020. bubble crash. And so I want to talk about something that I saw. No one's really talking about it, but it did raise flags for me in the sense that it told me, okay, there could definitely be a potential crash headed our way. At the beginning of 2021, this was the height of the 2020 stock market bubble. SoftBank, which is a massive Japanese conglomerate founded by Masayoshi Son, they sold all of their tech investments worldwide. And their sell-off triggered a massive drop in the market that led to a correction that eventually led to a crash. Being a part of that crash was extremely painful. This was a much more bigger crash, I would say, than the 2020 crash we had the year before. So many crashes. Mainly because most of us were pouring in new money into the previous 2020 crash, and we saw a big pop. We saw our portfolios reach incredible new all-time highs, and then all of that was diminished because we were, in fact, in a bubble. With a lot of speculative stocks, we also got to experience those that did not recover. This is why I continuously advocate for you all to be investing in blue chip stocks. As you're learning how to invest in companies that are obviously less likely to crash and that the majority of the United States is dependent on. Last week felt like a little bit of a flashback when SoftBank disclosed that it had sold its entire position in NVIDIA. It sold its position for $5.83 billion. That's a lot of money. And to sell their entire position out of a company that the market feels has so much promise for the future and is the driver because it is the hardware company that contributes to the growth of AI. I'm not going to lie. When I read that, it did feel concerning and it did make me feel like, okay, let me put on my seatbelt. Perhaps we are about to go on a ride, which is fine. And here is what keeps me grounded. And here is what helps me understand where I am with my portfolio and the importance of not getting caught up in short-term roller coasters. SoftBank in 2021 also sold out of their entire NVIDIA position. Had they not sold out in 2021, their position would have been worth $210 billion today. That's almost 35 times increase from their $5.83 billion worth in shares that they sold last week. Now, it's not really clear what SoftBank saw that potentially either alerted them that there would be a crash or if they were the ones that actually triggered it. But I can't help to see patterns in the market. It may mean absolutely nothing, or it may mean something. SoftBank did disclose during this sell that it had nothing to do with NVIDIA being overvalued. I think they said that in case someone else paid attention to the last time they sold out of their NVIDIA shares, perhaps to not necessarily trigger a sell-off. Who knows? I just wanted to share that because it did actually cause some fear. And I thought to myself, whoa, I do experience fear at the potential of a crash. Not enough fear for me to sell out or to panic, just enough for me to feel like, ooh, I remember how that felt in 2021. But more importantly, I know how it feels to recover. Other fears that we have stoking the market right now is the fact that we don't have all of the data due to the government shutdown. On Friday, the press secretary did sort of threaten that we may never receive the data, which did kind of send an alarm throughout the market. However, today, Monday, November 17th, we received information that we will in fact receive the job reports this Thursday coming up. And so that was one of the reports that we were mostly concerned about not receiving. So the threat felt kind of empty at this point, which honestly is no surprise from the Trump administration. I feel like they do this a lot and then backtrack what they say. But there's new news that we may now potentially not receive CPI data, which is confusing to me because CPI data is the one report that we get whether the government is shut down or not. So I don't necessarily know what to believe if this is just a threat. However, some of the Democrats are saying that perhaps they're wanting to withhold CPI data because they're wanting to hide data that is currently taking place in the market. I don't know if that's true or not. I haven't looked into it enough, and I think we have to wait and see if that data will in fact be released. Again, we know from last month's experience that no matter what, the CPI data has to be released because it is how Social Security checks are distributed. And so it's the one report that does in fact get released. Let's go ahead and review how the stock market performed last week. I did not forget about that. I actually intentionally pushed it out as we started to unpack this conversation because I felt that it would be much more valuable if I gave you these numbers at the end of the episode. So the Dow actually increased 0.6%. The S&P 500 increased 0.56%, and the NASDAQ increased 11%. As you can see, there's a lot of negative conversation in the stock market. There's a lot of volatility, but overall for the week, I think that the stock market performed decent numbers given the fears that are circulating in the market. Let's go ahead and take a look at how the market has performed from its all-time high, which I think helps put everything into perspective, most especially given the continuous conversation about the fears in the market. So from its all-time high, the Dow is down 3.87%. The S&P 500 is down 2%, and the NASDAQ is down 3.87%. As a reminder, if the indexes by which we measure the stock market, or if an individual stock drops by more than 10%, but less than 20%, this is known as a stock market correction. This is actually extremely healthy, and we want corrections to take place. What does cause continuous fear in me is when we see increase after increase after increase, because that does in fact lead us into a potential bubble. Watching the stock market pull back is healthy. We want to see that. And so we are not close to a correction at all. As I mentioned, from the all-time high, the Dow is down 3.87%. The S&P is down 2%. The NASDAQ is down almost 4%, which is the sector that has been impacted the most with technology. And so what we're seeing right now is healthy, a decline by more than 20%. That is a stock market crash. And if we're looking at our established companies that are contributors to the growth of the economy, then this can potentially be a buy-in opportunity. This is your reminder to feel the fear, identify what it is that is causing fears. Are you invested in speculative stocks? Is there something you need to clean up in your portfolio? Or is this just a fear of losing money in your portfolio, which is completely normal and natural and shouldn't necessarily lead us towards panic? Remember that as newer investors, we should be disciplined and have a long-term time horizon in the market, which means we should look into companies where we will stay invested for at minimum 10 plus years. You're listening to Investies podcast, a Cosmic Standard production. If you found this episode helpful, send it over to a friend. If you haven't rated us on your podcast application, please head over, take a few moments to rate us. It helps amplify the podcast and get it out to more people. Thank you so much for listening to this week. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
The holidays mean more travel, more shopping, more time online, and more personal info in more places that could expose you more to identity theft. But LifeLock monitors millions of data points per second. If your identity is stolen, our US-based restoration specialists will fix it, guaranteed, or your money back. Don't face drained accounts, fraudulent loans, or financial losses alone. Get more holiday fun and less holiday worry with LifeLock. Save up to 40% your first year. Visit lifelock.com/podcast. Terms apply.